Let's take a look at this 18-year-old science and tech media business making $169,000 per month in profit and listed for sale at an asking price of $4.8 million. On an annual basis, that is a 2.5x valuation multiple. I'm going to go through this business listing here, pick out some of the key details, share some of my own experience-based insight, and ultimately my quick take on this business's valuation at the 2.5x valuation multiple. Let's jump into it. And first thing I have to say is the $169,000 there is just really sweet. Like, that's per month. This thing is making a ton of money. They describe it as having explosive growth and hands-off management. And we can see right here an annual growth rate of 400%. Take note of that because that is very important. I'm going to kind of talk or harp about this a little bit as we go through it. Let's see what else they tell us about it. And let me kill my tool here. I can't click on the see more. Mind you, I don't know anything other than what I've read so far, what you've seen me read in this video. I've not skimmed down and taken a further look at it. Interestingly here, to point out before I go into the details, it is domiciled or registered in Algeria. Not sure how I feel about that. I'll talk about that too in a second. Let's just get, the rest of the details here out of this. It's an 18-year-old online publisher founded in 2007, covering science and space news for a broad audience. How does the business make money? Multi-channel advertising. Mediavine replaced AdSense in True Video at the end of September 2025. Okay, so this is display advertising here, really. Taboola and MSN also. This thing's getting a ton of traffic and monetizing it with display ads. There was a dip in traffic in October. Google retested the site after the ad/layout changes. So we can tell based on this context here that it's heavily dependent on Google organic traffic. And what else do we got? We had some monthly revenues, January to July. Peak record month was $210,000 gross ad revenue in May 2025. Net profit margin of 97%. Just holy cow. So they're just publishing a ton of content. Traffic comes from, this is interesting, direct search 50.4%, organic search 47%. This direct search here is really, really interesting. This means that people are typing in the domain name, at least what I take it to mean, are typing in the domain name and coming directly to the site. That's indicating that they've built a brand around this. That is very valuable and very powerful. If I were going to look into this business seriously, I would probably jump right into this. Like, how are they calculating this number, and is it legit branded direct search? People are seeking out this business directly. If this number is legitimate, this is very valuable. Very, very valuable. Let's keep moving on. Direct traffic comprises mainly of traffic from Google Discover and Google News surfaces. The traffic is supported by a disciplined daily publishing cadence and SEO best practices. Okay, so maybe the direct is not branded search. I'm not reading this as that. My first take on the direct search was this is branded search. It's not. It is Google Discover and this Google News surfaces. I'm not very familiar with that. So, in that case, the direct search number is not as valuable as I thought, because it's not people seeking out the brand directly. Instead, they're really just discovering it through Google's kind of feed-like media platform that they have out there. And I don't know much about it, or I know a fair bit about it because I advertise on it and I run ads on the Google Discover platform, but I don't actually use the Discover platform as a content consumer. So I really know very little about how it's about how users consume the content on there and how stuff is discovered organically on there. It is a good advertising source, though. And that, is now encompassed in the Google demand gen. What stands out? They scaled from 300K to 15 to 16 million page views within 12 months of relaunch. Consistent output of 7 to 15 articles a day, strong authority profile, lean operations, editor-in-chief plus 2 owners. Owner provides light twice weekly oversight, and the team is ready to continue with the buyer. Since moving to Mediavine, per session RPMs are higher. With stronger monetization per user and consistent editorial strategy, a traffic rebound in the coming months is realistic. Near-term opportunities: activate the newsletter infrastructure with 60,000 subscribers. Capture is set up, not yet mailing. This is interesting. Add affiliate partnerships and sponsored guest posts. Note on risk: as with any discover-heavy publisher, algorithm dependency is a consideration. Our diligence materials explain performance drivers and mitigation paths. Next step. Okay, how do you plan to fund it? All these things. What's included here? Reason for asking price: 4.8 million based on TAMP method, which I am not at all familiar with. I'm probably familiar with it in some capacity, but not with the acronym. And that seems like all the details. It's built on WordPress. Yeah. All right. So let's just go back to what I said I would talk about, the growth rate. And I guess I'm not ready to get to the growth rate. I'll talk about a bit more about that when it comes to valuation. Overall, what does the business do? If it's not clear already, it is fundamentally a blog or content website in the space news. They're monetizing it with display ads. That business model is highly platform dependent on Google. We've seen that in the teaser. A lot of talk about Google and SEO and organic and stuff like that. Because it is dependent on that, it is subject to platform risk. And the teaser alludes to that. If the algorithm changes for their traffic source, this business can go to zero overnight. That is not a far-fetched risk. How these businesses build value is through building a brand, and that is having branded search volume. That's something I also touched on as I was going through it here when we were talking about the direct search, which I thought was branded search, but it is not. They're lumping in all of these other platforms into this direct search thing. The a value indicator here, something that would substantiate the value of this business, would be high branded search, people seeking it out directly. This teaser doesn't mention anything about it. And ultimately that's valuable because that means that people are seeking out the brand. The business itself is not just relying on Google to serve the traffic. Now, aside from the platform dependency risk, this business is also, I think, subject to AI risk, and that is users are using AI more to get the content and information they need and discover other content online, and less on Google. So I'd be very curious to see how this business is adapting to that, if they've done anything, and how much traffic they're getting from AI models at this point. Right now, it doesn't seem like they're getting any, or they don't mention that they're getting any, and that could be a problem because the AI models are simply just regurgitating the content that this website publishes without actually sending users back to the business itself. Hence, they're fundamentally stealing their content and stealing their monetization source, which is the audience. And I don't like that. And that's a whole nother wormhole that I could jump down, but I think that is about to change in the near future because there's a lot of talk out there, or not talk, but actual tech being rolled out right now to prevent AI models and large language models from indexing and crawling websites for free and subsequently paywalling and telling the AI model it has to pay or it can't access. Very interesting and developing space right now. But ultimately, it's still a risk for this business. And when we look at the valuation multiple here at a 2.5x for a business making nearly $2 million a year in profit at a 97% margin, that is a relatively low valuation multiple. Before I talk more about the valuation multiple, let's just talk about the growth opportunities here. And I think the newsletter infrastructure is huge, right? They haven't done anything with the subscribers. And that is good, but also problematic, right? Because it kind of means that the 60,000 subscribers are really valueless if they haven't done anything with them already. You've got this 60,000 email list that has not been receiving emails. So when you hit the first round of them with emails, most of them are probably just going to not open it or unsubscribe because it's been so long since they subscribed. But at the same time, you do have something there, and it shows that the audience will opt in for emails. So as the buyer of this business, you're certainly going to want to figure out how to monetize this email list and continue to grow it, because this is how you pull users away from Google and ultimately build your own audience that you own. The other thing too would be building content on other platforms, largely going to be the reel style short form video platforms, Instagram, TikTok, YouTube Shorts. All of those are highly engaging. And then behind that, monetizing through affiliate partnerships and guest posts. I think there's a lot of opportunity here, and that's certainly something valuable for the business, and it's certainly a bull case for acquiring the business, but we have to consider this has not been executed by the seller, so it's not something you should pay for. So on that note, let's segue to the valuation multiple here and the ultimate valuation of the business. My approach is to value the business unit as a whole, forecasted by what the earnings will be going forward in the future once you account for all the expenses that you will have with the business under your ownership here. So let's just talk about the business unit as a whole. We've got a content site. It's making good money right now, but I don't see anything that indicates they've established a brand. This business is really just a leech in the world of Google, a leech on Google in the world of the internet, or in the universe of the internet. This business does not exist, it seems like, unless I'm getting something totally wrong or missing something. But based on the details here, it doesn't seem like it really has much of a existence if it's not getting traffic from Google. It's very, very, very dependent on that Google traffic. For that reason, I would not value this business at anything more than a 2x on what it currently is now. If it had email and was pulling in substantial monetization from the email to the point where you could run ads to get users on the email list, I think this business would be a lot more valuable. If it had very high branded search to where we could see that users were finding this business and seeking it out directly, it would be much more valuable. But it doesn't have either one of those things. Again, this business is really just serving content to users online that are serving content to Google users, and Google's trying to get rid of the middleman and just serve the content themselves. And then you also have AI, which is coming for Google's share of how users find content online. I think a 2x valuation on the business as a whole is very, very, very generous, and only for somebody that is very experienced at operating online businesses and likely has multiple, such to the point that you could offset the risk if this thing really takes a haircut. And takes a haircut in traffic, I mean, gets whacked by an algorithm. And also, most likely for somebody that's going to pay cash for this, and if the revenue gets cut by 75% overnight, which, mind you, it still would make a good profit, right? It'd be $500,000 per month in profit per year if it gets cut by 75%, but they're not going to lose any sleep over it. So this is really for a very diversified investor in online business assets. It is aged. I do like that, but still, I don't see this being worth a 2.5x valuation multiple. And that said, we would want to factor in what is likely going to be the growth going forward, or not what the growth is going forward, but what the income is going to be growing going forward. Is it going to be growing or declining? We see here that it has had an annual growth rate of 400%, and most of that has happened in the last year. I think we saw something about that down here. Where was it? Maybe it was this line. Yeah, I can't find it here. I'm not going to take up any more time skimming through the listings. Oh, scaled from 300K to 15 to 16 million page views within 12 months of relaunch. Okay. So this thing, and I guess that kind of, does that align? 300K to a 400% growth rate? 315? No, not really. It doesn't really align. That's the page view number scaled at a higher growth rate than the profitability on an annual basis. Whatever goes up like this, as fast as it rips up, can also fall down just as hard. So I think that you would be naive to assume this profitability is going to continue. I think that this really needs a haircut, and not scientifically estimating this, I would say that 50%, right? Assuming a 50% fall in the next 12 months is realistic and not far-fetched. So let's just forecast this out over the next 12 months. This 1.9 million in profit is really only 950,000 in profit. All right, so 950,000 in profit at a 2x multiple, which is what I said the business unit as a whole is worth. This becomes a $1.9 million business, and that is a lot less than the 4.8 million that they're asking for. But I think that is fair considering the business unit that they've got established and what they've built here and the value of that, and the future income going forward. The seller here is really looking to be paid out, assuming that this growth that they've achieved and where it's at now is going to be robust and persistent going forward. But I really don't think that is the case. And in my experience, acquiring and owning online businesses, that is often not the case. And that is likely what the seller realizes, hence they want to sell now, because why not just keep cashing your check of $1.9 million a year in profit with damn near no capital outlay every year, because this business is operating in a 97% margin. Like, that's the fucking dream. And the seller hardly works in the business. They said just a couple hours a week or something down here, right? Why sell it at a 2.5x multiple? Well, I'll tell you the reason, and that is they know this number is likely not going to continue going forward. It's going to take a haircut. And if it haircuts, to 50%, and based on the business unit's valuation as a whole, it's a $1.9 million business. Would you sell it and get nearly $3 million more, $3 million more right now if there's a sucker to come along and pay you? Yes, you absolutely would. And that's what the seller here is banking on. But in my opinion, you'd really have to be a sucker to pay this $4.8 million. And quite frankly, I don't think it is worth that $4.8 million. That's my opinion. What is your opinion? Is this business worth this 2.5x valuation multiple on what I'm assuming is the last 12 months of profit, leading to the $4.8 million asking price? Let me know in the comments below. On that note, guys, if you found this video helpful or insightful, you know the drill. Smash that like button to help me out in the YouTube algorithm. I am calling it a wrap and signing off on this one.